Markets are betting that inflation is falling and rate cuts are coming. But that entire story depends on one thing: oil coming down. And right now, it isn't. If that doesn't change, this market is priced wrong. Here's what most investors are missing. Oil doesn't need to spike to cause a problem. It just needs to stay high, long enough. That's it. And that's exactly the environment we're in right now. Over the past year, oil has been volatile. Sharp moves up, then pullbacks, then stabilization. And every time it pulls back, markets relax. As if the problem is solved. But zoom out. According to Reuters, oil prices surged during recent geopolitical tensions and, even after pulling back, remain well above pre-crisis levels. At the same time, global energy supply is still tight, with limited spare capacity, something the International Energy Agency has warned about repeatedly. That's not a clean setup. That's pressure building underneath the surface. And this is where the market narrative starts to break. Because right now, markets are pricing a very specific outcome. Lower inflation. Lower rates. Stable growth. But that only works if energy keeps falling. Now think about how the system actually works. Oil drives transport costs. It drives manufacturing costs. It pushes up food prices through logistics and production. When oil moves, it raises costs across the entire economy. And companies don't just absorb that. They pass it on. Prices rise. That's inflation. This is exactly what we saw in 2022. Energy prices surged, and inflation followed. Central banks had to react aggressively. Rates moved higher, and markets repriced fast. Now compare that to today. Inflation has come down, but not fully. Core inflation is still above target in most major economies. And according to the IMF, energy shocks remain one of the biggest risks to inflation staying higher for longer. That's the part markets are underestimating. Because if oil stabilizes at these levels, inflation doesn't fall cleanly. And if inflation doesn't fall, central banks don't cut. They wait. They hold rates higher for longer. And if rates stay higher for longer, valuations across equities, real estate, and risk assets come under pressure. These bubbles don't hold. That's the chain reaction. Oil drives inflation. Inflation forces central banks. Central banks drive rates. And rates move markets. And this is where it gets serious. Because markets today are not positioned for that outcome. They are positioned for relief. Lower inflation. Lower rates. Easier conditions. But oil is not confirming that. It's doing the opposite. It's keeping pressure in the system. And here's the key point. Oil doesn't need to move higher from here to cause problems. It just needs to stay elevated. That's enough to delay rate cuts. That's enough to keep financial conditions tight. That's enough to slowly squeeze the system. This is how macro shifts actually happen. Not with one big shock, but with one variable that refuses to move in the direction everyone expects. And right now, that variable is oil. Because the global energy market is not loose. OPEC supply decisions remain tight. Geopolitical risks aren't going away. And years of underinvestment in energy infrastructure have limited how quickly supply can respond. According to the International Energy Agency, spare capacity remains constrained, which increases the risk of further volatility if supply is disrupted. That means this is not just a short-term issue. It's structural. And once it's there, it doesn't go away. They stay. They build. They force adjustment. So what does that mean for investors? It means the current market setup is fragile. Because it depends on something that hasn't actually happened yet. Sustained disinflation driven by lower energy costs. If that doesn't happen, everything shifts. Rate cuts get pushed out. Markets reprice expectations. Volatility increases. And the biggest risk is not that investors don't see this. It's that they see it, but underestimate it. Because the assumption right now is simple. The worst is over. But oil isn't confirming that, at all. And until it does, stop focusing only on what central banks might do next. Start paying attention to what is forcing the decisions. It's not growth. It's not demand. It's energy. But higher pressure, for longer. This isn't financial advice. It's a framework to think differently about markets.